Booyah! The financial world just got a jolt of electricity, and if you're anywhere near the tech sector, you're probably feeling the aftershocks. This isn't just another day on Wall Street. This is a seismic move that's got everyone talking. The market just got rocked. Hard. We're talking about a shakeup that's sending ripples through portfolios and boardrooms alike. Morgan Stanley, one of the most influential names in global finance, has just slammed the brakes on some of the biggest tech hardware giants out there. When a titan like Morgan Stanley makes a move, the world listens. They've downgraded Dell Technologies, HP Inc., and Hewlett Packard Enterprise, three companies that have been pillars of the tech hardware world for years. In a single sweeping move, Morgan Stanley's analysts slashed ratings and chopped down price targets, sending a clear message to investors everywhere. So, what's behind this dramatic shift? One word: memory. The cost of DRAM and NAND chips, the essential building blocks for everything from laptops to servers, is absolutely exploding right now. These skyrocketing prices are threatening to devour profits and squeeze margins for tech manufacturers. This isn't a minor blip or a temporary hiccup. It's a major storm cloud on the horizon, and it's got investors and executives alike on edge. Morgan Stanley is sounding the alarm, warning that the health of the entire tech hardware sector is at risk. If these memory prices keep climbing, the pain could spread far and wide. When a Wall Street powerhouse like Morgan Stanley makes a coordinated move like this, you don't just shrug it off. You pay attention, because it could signal a much bigger trend. Their top analysts are seeing trouble brewing on the horizon, warning signs that could spell real challenges for investors who aren't prepared. That's why they're waving a giant caution flag, telling everyone to proceed with extreme care. This isn't the time for risky bets or blind optimism. So, if you're holding on to Dell, HP, or HPE, it might be time to skedaddle from these names for now. The market's changing fast, and you don't want to be caught on the wrong side of this storm. Let's break down the memory supercycle. It's a term that gets thrown around a lot in tech and finance circles. But what does it actually mean? At its core, a memory supercycle is a period when the prices of memory chips, think DRAM and NAND, the building blocks of everything from your smartphone to massive data centers, don't just rise, they skyrocket. This isn't your average price bump. It's a dramatic, industry-wide surge that can reshape the entire tech landscape. During a supercycle, memory chip prices surge much faster and higher than usual, putting intense pressure on hardware makers. Imagine you're running a company that builds laptops, servers, or even gaming consoles. Suddenly, the cost of a key component, memory, starts climbing at a breakneck pace. Your budgets get squeezed, your forecasts go out the window, and you're forced to make tough decisions just to keep your products affordable. Right now, we're seeing exactly that. DRAM and NAND prices have jumped an astonishing 50% to 300% in just 6 months. To put that in perspective, imagine if the price of gas at your local station tripled overnight. It would send shockwaves through the entire economy, and that's exactly what's happening in tech. Companies like Dell and HP can't simply sidestep these costs. Memory chips are essential for every product they make, from entry-level laptops to high-end workstations. There's no substitute, no workaround. When memory prices soar, these companies have no choice but to pay up, and that cost eventually trickles down to consumers, or eats into profits. History shows that it usually takes about 6 to 12 months for these price hikes to fully show up in company earnings. But when they do, the impact is brutal. Profit margins get squeezed, quarterly reports start to disappoint, and investors get nervous. It's a domino effect that can last for months, sometimes even years, as companies scramble to adapt. Morgan Stanley, one of the world's leading financial institutions, is sounding the alarm. Their analysts argue that Wall Street is being far too optimistic, turning a blind eye to the looming margin squeeze that's about to hit the tech sector. While some investors are betting on a quick recovery, Morgan Stanley sees trouble ahead. They predict a significant margin decline for 2026, warning that the pain from today's supercycle will linger far longer than most expect. While other analysts are forecasting improvement and a return to growth, Morgan Stanley is taking a much more cautious, and some would say, realistic, stance. This is a high-stakes bet, with billions of dollars on the line. Someone's going to be very wrong. Either the optimists who think the worst is over, or the skeptics who see more pain ahead. The tension is palpable in boardrooms and trading floors alike, as everyone tries to read the tea leaves and position themselves for what comes next. Morgan Stanley is betting it won't be them. They're doubling down on their warning. The pain is coming, and it's going to hit hard. For tech companies, investors, and even everyday consumers, the memory supercycle is more than just a buzzword. It's a storm on the horizon. No, no, no. Why the urgency? Morgan Stanley sees memory inflation as a freight train about to hit earnings. Wall Street's been too complacent, focused on AI growth and PC refresh cycles, ignoring surging component costs. At the same time, demand for traditional hardware is weakening, a double whammy. Costs are up, demand is down, a toxic mix for profits. With year-end guidance coming, Morgan Stanley wants clients out before the bad news hits. They expect margin erosion to show up in the next few quarters. This downgrade is a preemptive strike. Don't get caught off guard. Dell just got body slammed, a rare and brutal double downgrade from buy to sell, sending shockwaves through Wall Street. Not only did analysts pull the rug out from under Dell's stock, but they also slashed the price target from $144 all the way down to $110. That's a massive vote of no confidence, and it's got investors scrambling to reassess their positions. This kind of downgrade doesn't happen every day, and it signals some deep concerns about Dell's future prospects in a rapidly changing tech landscape. Dell's massive exposure to the PC and server markets is a double-edged sword. On one hand, they're a dominant player, but on the other, it leaves them especially vulnerable when memory costs spike. With memory prices on the rise, Dell's costs are ballooning, squeezing their margins and making it harder to stay competitive. Every uptick in memory prices hits their bottom line, and with so much of their business tied to these products, there's little room to maneuver. Even Dell's much-hyped AI server business, which has been a bright spot in recent quarters, isn't enough to save the day. While demand for AI servers is booming, the reality is that these products come with much lower profit margins compared to traditional enterprise hardware. So, even as Dell sells more AI servers, the overall profitability of the company is dragged down. It's a classic case of growth that doesn't translate into healthy profits. Morgan Stanley didn't pull any punches. They slashed their 2027 gross margin forecast for Dell to just 18.2%. That's a major drop from previous expectations, and it paints a grim picture for Dell's ability to generate healthy profits in the years ahead. Lower margins mean less money to invest in innovation, less flexibility to weather downturns, and ultimately, less value for shareholders. The pain doesn't stop there. Earnings per share estimates have been cut by a staggering 12%. That's a clear signal that analysts expect Dell's profitability to take a significant hit, and it's a red flag for anyone hoping for a quick turnaround. Lower EPS means lower returns for investors, and it often leads to further downward pressure on the stock price. Despite all these warning signs, the market has been absolutely obsessed with the AI narrative, pushing Dell's stock higher and higher. Investors have been so focused on the potential of AI that they've ignored the mounting cost crisis brewing beneath the surface. It's a classic case of hype blinding people to the underlying risks. But Morgan Stanley is sounding the alarm, warning that the so-called memory supercycle, a period of rapidly rising memory prices, will outweigh any gains Dell might see from the AI boom. In other words, the cost headwinds are just too strong for AI growth to offset, at least in the near term. The bottom line? The Dell train is barreling toward a wall, and unless something changes fast, investors risk getting run over. Now's the time to pay attention. Don't get caught on the wrong side of this disaster. HP Inc. also got hit, downgraded to sell, price target cut to $24. Even with a PC market recovery, rising memory costs will eat into every sale. Morgan Stanley cut HP's 2026 gross margin forecast to 19.7%, well below consensus. They predict HP's earnings per share will drop 9% despite higher sales. The old bull case, PC recovery equals profit, is broken. The cost spike is overwhelming the revenue boost. Investors expecting a profit boom may get a bust instead. The story has changed. Time to wake up. Hewlett Packard Enterprise, HPE, was a Morgan Stanley favorite, no longer. Downgraded to hold, price target cut to $25. HPE faces rising component costs and the risky integration of Juniper networks. Morgan Stanley slashed their 2026 gross margin forecast by 260 basis points to 32.9%. EPS estimates dropped from $2.52 to $2.18. The dream of a smooth Juniper deal is fading. Now, HPE must juggle a tough acquisition and surging costs. Morgan Stanley says, pause, take profits, and wait. The road ahead is rocky. This isn't just a Dell or HP problem, it's sector-wide. When memory prices spike, hardware makers' cost structures implode. For every 10% increase in memory prices, gross margins can drop up to 130 basis points if unmitigated. With prices up 50–300%, profits are vanishing. It's a wealth transfer from hardware makers to memory suppliers. OEMs are trapped, absorb costs and lose profits, or raise prices and risk losing customers. Morgan Stanley sees Dell and HP as most vulnerable. The pain will ripple through earnings for years. This is a survival test. Are these companies helpless? Not quite. They have mitigation strategies, but Morgan Stanley doubts they'll be enough. They'll try to raise prices, redesign products, and squeeze suppliers. Cost-cutting, marketing, R&D, even layoffs is on the table. But pricing power is limited, and cutting too deep hurts long-term growth. Morgan Stanley estimates OEMs can only offset about 70% of memory inflation. That leaves a 30% gap hitting margins directly. In a thin-margin business, that's devastating. The wave of inflation is too big. Mitigation is like a sandcastle against a tsunami. The wave wins. So, what should investors do? Morgan Stanley's message: be careful. The easy money in hardware stocks is gone for now. If you're thinking of buying, don't. Too much uncertainty. If you already own these stocks, consider taking profits, especially in Dell. For HP and HPE, the downgrade signals better opportunities elsewhere. The narrative has shifted from AI growth to margin crisis. Watch upcoming earnings and guidance closely. Focus on margins, not just revenue. Until there's clarity, these stocks are in the penalty box. There are safer places for your money. Booyah!